Welcome back to the Global Thinking Podcast. I'm your host, Rob Duncan, and today we're joined by our lead portfolio manager, Mr. David Kletz. David, welcome back to the show.
Thanks for having me back on, Rob, and Happy New Year.
Happy New Year to you as well. How was the break?
It was a little bit hectic on my end. As with most of the young parent families that I know, we were dealing with some illnesses and juggling responsibilities, but all in all, it was a nice time with the family, so no complaints. How about yourself?
That's awesome. Yeah, Dave's got a couple of kiddos at home. I got three kiddos at home. I described my time off as a beautiful chaos, and that's basically what it was. My kids were very happy. Their aunts and uncles and grandma and grandpas all spoiled them, but it was good fun. Actually, a lot of skating. I did a lot of outdoor skating right before we had the big thaw here in Toronto, so that was a big positive. And yeah, here we are, already midway through January. Today we're doing something a little bit different. I mean, part of this is pretty traditional. This is the Global Thinking Podcast. We are attempting to record this to provide a bit of a video podcast. We are listening to our listeners and collecting feedback. People want to actually see us, which is that's probably the first for me. But today, of course, is Wednesday, January the 14th. We're both in Toronto. David and I are in Toronto. And we're going to be walking through a bit of a 2025 recap. The year that was. Interesting. I called it a popcorn year or a grab your popcorn year. And they'll be sharing a little bit of Forstrong's outlook and getting Dave's inside perspectives from the investment team on what this means, the investment implications, and what people should be watching for 2026. Dave, any comments before we get rolling here?
Yeah, I mean, it was a year just laden with geopolitical news and big kind of headline news. But I mean, I guess you wouldn't know it by looking at the end results, which was another really strongly positive year for risk assets, despite all those risks that did seem to come to fruition. So a bit of an interesting year from a bunch of different angles, but we'll get into it shortly, I suppose.
We most certainly will. And I think we say this every year that if you had fallen asleep on January 1st and woken up on December 31st, there would have been high fives all around for the amazing job that investment managers had done delivering, looking at, actually, time for me to give you some numbers. Looking at some results, the MSCI All Country World benchmark, so this is all equities around the world, returned about 16.5%. Now, as you get into the underlying components, obviously you've got Canada, the US, Europe, and emerging markets. Canada was the top performing market, 31.5% roughly. US trailed a bit behind, 12 and change. And I would say the surprise for a lot of investors, less so for us, was the international and emerging markets. International returned about 25, EM slightly higher at about 27 and change. And so it was a year of stocks last year. And I think what people forget is that you're right. There was a lot of headline risk. People forget, the Liberation Day, the 25% drawdown that happened in April. That was a pretty volatile period. Everyone's kind of quoting the recovery. They're like, oh, look at this incredible recovery. Well, you still had that drawdown. And a lot of people panicked and sold the cash at that point in time. But to just recap, a great year for stocks. Wasn't a great year for fixed income investors. I'm just looking at a bunch of Canadian, US broad bond benchmark returns floating somewhere in the 2 to 3% range, which is barely keeping up with inflation. So I think this is a back-to-back year where yet again, actually 3 years in a row, equities completely trounced fixed income. But again, this is what we call a risk on appetite. And to dive deeper into those, to go over the schedule for today, sorry to bounce around, doing a recap for last year. We're going to talk a little bit about Forstrong's views for this year, how we're positioned, and then we're going to dig into kind of Canada, US, the rest of the world, and talk about some of the other issues or topics that people have submitted with regards to commodities specifically. But as you dive into each of the individual sectors that kind of led these results, in the S&P returning over 30%, S&P TSX returning over 30%, this was led very heavily by materials, which returned almost a 100% year to date for 2025. Gold, obviously the biggest driver in terms of a subsector, about 130%. Of course, financials following up with that one. So lots to kind of dig in here as you go down from the very top line asset allocation and get into the sub asset classes. And with that, David, I'm going to pass the mic back over to you. Just walk us a little bit through, last year. What, you called it again, a year of headline risk. How does that year wrap up and transition in 2026? Are we about to see something similar, or is this going to be a completely different year?
Yeah, so I had previously called 2025 somewhat a tale of 2 years, like the period before Liberation Day and the period after. And the period before was characterized by the US starting to underperform international markets. This is equities. And that was something we hadn't seen in quite a while. It was basically the US was the only game in town for a couple of years prior to that. Then we had Liberation Day, and this was the major decision that asset managers had to get right, was to basically hold on to their shirts during Liberation Day and not sell. It's obvious to us, I guess, in hindsight, that you should have hung in there or perhaps increased risk with expectations that governments around the world would deploy fiscal stimulus, and worst case scenarios from the trade tariff threats would not necessarily materialize. But at the time, it's quite a difficult process. And I do think a lot of managers did end up de-risking their strategies, and it's understandable why they do so. With the world's largest consumer putting tariff rates up to, highs that we haven't seen in around 100 years or so, it could be very impactful if things materialized at face value, but that clearly wasn't the case. So in keeping risk on and potentially adding to risk in the aftermath of April 2nd, we saw a very steep recovery for equity markets. And international continued to perform well, although the gap between international and U.S., I would say, tightened somewhat after Liberation Day, whereas, as mentioned previously, before Liberation Day, the international side was doing quite a bit better. But those two characteristics of the year, I think, really defined overall equity market returns. Obviously, for Canadian investors, it's also ironic that we have one of the strongest performing equity markets in the world when we were the target, not the single target, but we were a target of quite a lot of cross currents and drama emanating from the White House, particularly just considering how important our relationship from a trade perspective, economic perspective with the U.S. is, that our equity market did so well. But also the Canadian economy itself was quite lukewarm during the year, whether it be the labor market, the housing market looked pretty shaky as well too, and we know that the housing market has outsized importance in Canada. So there's certainly a bit of a disconnect there between the economy and stock market returns, which can be the case, but this was a pretty profound discrepancy between the two. And definitely the message from metals, which our CIO and CEO Tyler Morty just wrote an Ask Forstrong piece about, is becoming very interesting to discuss. But for the TSX, as you mentioned, we have a disproportionate weighting in gold mining equities here, and that certainly did wonders for total returns for the broad market. But our financial sector, despite some of the headwinds as well, also hung in too. So very, very interesting year, even perhaps more so for the Canadian equity market as we look into 2026.
Yeah, I think a lot of Canadians were really welcoming that rally. I think the Canadian market had severely lagged behind the U.S. and even global markets post-pandemic. So with that, let's get into a bit of our macro mix. And so the team did its quarterly review in December and placed its new trades. Can you just walk us through, like, super high level, like, what is our view from a firm perspective in terms of overweights, underweights with regards to stocks, bonds, and cash? And then once you answer that, we'll kind of get into the broader regions.
Yeah, for sure. So maybe I could just set the macro tone a little bit to kind of justify our thinking here. And that is, generally speaking, firming economic momentum in international markets. So we think that a recovery in Europe has broadened out, has really strong momentum behind it, and we don't see anything in the short term necessarily to derail that. There's always risk factors, of course, but it's probably the most favorable outlook we've had for Europe in a number of years. Asia and selected emerging markets also appear to have firming growth momentum as well too, as we head into the new year. And despite some wobbles for the U.S. economy, particularly the labor market showing a few warning signs, we view the U.S. economy as still quite resilient heading into the new year. On top of that, we have major economies worldwide deploying fiscal stimulus, whether it be in Europe, like the traditionally austere German economy. The impact of fiscal stimulus will start to be felt more acutely this year. We had a big fiscal package announced by Japan, which sent their bond yields soaring. In the U.S., the one big beautiful bill, the impact of that will be felt more acutely in 2026. So it seems to be a scenario where you're pouring fuel on the fire. You already have a relatively solid economic backdrop, and policymakers are just stepping on the gas pedal. Whereas kind of historically, a more Keynesian approach would be to deploy fiscal stimulus countercyclically when you had weakness in your economy. So that's a very favorable environment for risk assets. It should be supportive of earnings. I guess what's tempering our enthusiasm a bit is that we have had such a strong run in the past few years for equities, and the underlying fundamentals, the price rally that we've had has outpaced those underlying fundamentals. So we have seen a deterioration in valuation multiples. Now, valuation multiples are not a great indicator of short-term returns. It's not telling us much. So certainly, we've opened the year with further strong performance, pretty broad-based across the world. But it does become self-limiting at some point. The underlying earnings do need to be able to keep pace with the expansion in valuation multiples and the expectations that have been baked into those. So that would somewhat dampen our enthusiasm to have 2026 be as strong of a year as we saw in 2025. But obviously things can change quickly. So from a high level, we remain risk on with our strategies. We don't have a massive equity overweight, but we definitely still are overweight equities and modestly underweight fixed income. From the fixed income perspective as well, with central banks either on hold or still cutting rates in most markets, our bias would be towards shorter duration. We do think there's a chance to see further yield curve steepening, where the short end of the curve follows monetary policy lower, and the long end of the curve is potentially sees upwards pressure on yields due to the pretty solid growth trajectory. So overweight stocks, underweight fixed income, short duration, and we're looking for other sources of diversification too. And so particularly in our more growth-oriented portfolios, we're still holding gold bullion despite the very strong performance in recent years. And then also industrial metal exposure as well too. So one thing we did towards the end of 2025 was add copper miner exposure, which is supported by a number of factors I think we'll probably end up discussing in a little bit here. But that's the Cole's notes for positioning heading into the year.
Yeah. All right. Well, don't get too far ahead of us here. Don't give away all of our secrets before we kind of dig into them. All right. So we're overweight stocks, underweight fixed income, relatively neutral or underweight, I think, on the cash perspective.
Yeah, cash held relatively neutral. We do have a bit of dry powder to deploy should we see a buying opportunity emerge. But yeah, generally speaking, cash and our gold bullion exposure are our preferred methods, and short duration bonds, I suppose, as well. You could lump into that to hedge some of the equity risk in the strategies.
10-4. All right, let's talk about some individual regions or individual country tilts within there. So if we looked at kind of broadly how the investment committee would be reviewing exposures. We've got Canada, we've got US, international emerging markets, Japan. How do we see tilts in each of those countries?
Yeah, so I mean, one of our preferred regions at the moment continues to be Europe. As mentioned, we continue to see firming growth trajectory there, and we've rewarded it as such with allocations. So we have a number of different types of tilts in Europe. We still really like the financial sector, which has been on a tear of late. They really are the financials, that is, and the banks specifically, the barometer for economic health in Europe. And as we continue to be optimistic in that regard, that positioning continues to make sense. We also like some pro-cyclical exposures, like the Swedish equity market, which we think should benefit from a slow recovery. I wouldn't say a steep recovery in the German manufacturing sector. They're pretty deeply entwined in that regard, as well as we've seen a stabilization in their housing market after a pretty scary period where Swedish households are highly exposed to variable rate mortgages, and with the Riksbank previously tightening, that was definitely a dangerous period for the Swedish economy. But we've made it through that, and households' balance sheets as well as corporate balance sheets made it out relatively unscathed. So I think it's a good starting point for Swedish equities. We also still remain optimistic towards Asia. There's a number of markets there. I think Japan, there's been a lot of uproar about the fiscal stimulus package, I suppose, particularly on the bond side. But from an equity side, we'd expect their global exports, global export orientation of the Japanese equity market to be well rewarded in this environment. And then on the domestic front, having fiscal stimulus come into effect, and a generally reflationary environment in Japan, which is something we haven't seen in a very long time, that should continue to be positive for Japanese stocks. And I would say the other standout would probably be China. Now, it remains to be seen how much some of the fiscal stimulus and other supportive policies that have been rolled out by the government in recent years, how far they're willing to push that. We get the sense that they're quite hesitant to deploy too much too soon. But the one interesting feature, particularly on the onshore domestic market, the A-share market, is that turnover is starting to really pick up, and it's showing investor interest is starting to become renewed and vigorous, I would even suggest, for mainland investors. And that's following years where consumer and investor sentiment domestically in China were just abysmal, following the crackdown in the tech sector, following all of the turmoil in their real estate market. So that's a really good sign. I mean, historically, the Chinese equity market has been prone to be somewhat of a momentum-driven market. So when you get some positive momentum in China, hang on to your coattails. It can be a pretty wild ride. There's obviously risk factors involved with that too. If things get too wild and woolly, the regulators do tend to step in and crack down on certain practices. But for the time being, China has a number of interesting facets to it, just beyond momentum. Not least of which is their leap up the value chain into all types of new industrial segments, and becoming a powerhouse in them, of everything from electric vehicles to industrial equipment in numerous markets around the world. So really interesting things going on in the East. And I think that's the international positionings outside of North America are probably the most interesting to the team still this year as well.
Yeah, that's awesome. All right, well, let's shift gears a little bit. You didn't provide too much commentary on Canada and the US. So let's start with Canada. So we did kind of talk that it was the number one performing developed market, I would say. And thanks to the performance of materials and financials. But the big question is, is this sustainable? The economy was, like you said, kind of lukewarm. GDP was still growing faster than the US, and interest rates had come down quite nicely. But the real estate market was still in a fair amount of turmoil, I would say. I think that's, from anyone who's an investor that's holding any investment in real estate funds, there's been a lot of issues with regards to liquidity on that front. So this is still something that's being digested. So the big question is, can Canada have a repeat year in 2026, or maybe have we gone a little too far too fast?
Yeah, I mean, my national pride here aside, I would not expect another year like 2025. I mean, 2025 was a banner year, and anyone calling for 30% years in perpetuity, that's a losing bet. I mean, I'd be certainly happy to be proven wrong in this regard, but that would not be my base case, particularly because a big driver of returns was precious metals and the precious metals miners. And I mean, we still have a favorable view towards precious metals and certain commodities, but they can't keep rising at near triple digit levels, into perpetuity as well either. So that driver won't necessarily go into reverse, but will have to taper off at some point. I think there's a number of positive things, ironically, we've been almost pressured into doing, given the turmoil with our biggest trading partner, the US. And I do think, the Carney administration is prioritizing the right things at least from an economic perspective, diversifying our export base, or at least attempting to unfreezing trade relations with other nations like China, as an example. Trying to get important infrastructure projects built so that we can open up new export markets as well. I mean, and then I suppose one of the other quote unquote low hanging fruit would be to try to tackle intra-provincial trade barriers, which admittedly the federal government does not have necessarily direct oversight over. But a lot of positive things to be constructive about, kind of looking out over the next few years. But these are all things that are not going to be solved with the flick of a switch. These are things that are going to take a while to bear fruit. And considering the year that we just had, it seems like there are expectations that are becoming baked into the Canadian market already. So I think there's going to be challenges still remaining from the real estate market. I think there's more work to be done there. I don't predict any sort of severe crash or worst case scenarios materializing, but what could happen is there could be kind of a long sluggish workout period after the downturn that we've seen, and that would definitely put a dampener on the Canadian financial sector looking forward as well too. So I mean, gaming it out, I mean, I think there's still lots to be constructive on long term in Canada, but I think it would push us probably more towards a neutral outlook for the Canadian equity market rather than exuberance.
That is a very pragmatic response from a seasoned investment professional, David. So thank you for sharing that. Yes, I think betting on another repeat year would be, I think, a losing bet. I can't even remember the last time Canada returned, 30% annually. We'll have to wait for one of our listeners to send me that email. But I mean, looking at the financials, like financials had a year they hadn't seen since like basically 08, 09 or 10 even. And materials hadn't seen a year like that since the 90s. So to get those two things firing at the same time was pretty impressive. And as you mentioned, Canada's in the midst of some pretty massive changes politically and from an infrastructure investment perspective. And those are going to take years. They're very, very long years. And actually, one of those discussions is happening very shortly as Prime Minister Mark Carney is now meeting with Chinese President Xi Jinping. How important is this to Canada? How delicate, I would say. And I definitely know I've got a listener, Greg in the Prairies, who's been pretty focused on tariffs for canola oil. So what are your thoughts on this one right now and how important this is?
I think it's extremely important. And I don't envy the Carney administration because it's a bit of a tightrope walk between balancing the relationship with the US and the relationship with China. But if we are going to diversify our exports and we are seeking to unlock new markets for our exports, I mean, it's very difficult to do that without China. I mean, one of the world's second largest economy, massive consumer base, a huge industrial base that just soaks up the world's excess raw materials. And yeah, I mean, we've had basically frozen relations with them for a good few years now. And, I just can't imagine a scenario where we succeed at these aims with our exports without having a better relationship with China. That doesn't mean that from like a social perspective, we're going to all of a sudden be in, alignment. I think that's a bit of a pipe dream at this point, but there can still be, I still am optimistic that there can be a relationship that's more strictly economic in nature. And we'll see. I don't think, one trip necessarily solves all the issues that have accrued over the past few years. But I'm very optimistic that the dialogue at least has been restarted, and we'll see what materializes.
Fair point. Thoughts on further rate cuts in Canada, or do you think we're stuck where we are, 2%?
Yeah, I wouldn't necessarily completely shut the door on maybe one or two more cuts, but that wouldn't necessarily be my base case. I think we're basically done at this point. Yeah, I think if not anything else, the central bank, the Bank of Canada, wants to maintain some firepower for future downturns. I don't think any central banker out there really wants to get back down towards that lower zero limit that we had and all the alphabet soup of QE and ZERP and things that were anomalies coming out of the global financial crisis. So, I mean, our economy seems to be stabilizing, so that's good news from the growth standpoint. Inflation is within striking distance of target. So in my mind, I don't see any real need for the Bank of Canada to tinker further at this point, but we'll see. There can obviously be fluctuations throughout the year, and could there be one more rate cut? Sure. But yeah, my guess would be that we stay on hold for this foreseeable future at this point.
Sounds good. All right, shifting gears to the U.S. and speaking of central bankers, Jerome Powell had a pretty interesting post on X last week as the Federal Reserve was served with federal court subpoenas for some overspending on the rebuilding or the refurbishment of their building. So it's definitely some friction and some between POTUS and the chairman of the Federal Reserve about lowering interest rates. And this is nothing new. However, this is the first time that central bankers ever been served with subpoenas trying to reduce interest rates and support the broader economy. So this is definitely an interesting time. But before we get into more on that, I mean, tell me something that we don't already know about U.S. performance. Like, it had a decent year, high teens. Granted, there was a very, very sharp correction at April Liberation Day, but the key drivers remain. It's large cap. It's generally tech focused or communication services, and these firms continue to kind of ride this AI wave with capital spending in the $500 billion, and it's expected or projected to increase beyond that again this year. What is the actual outlook and GDP growth prospects for the U.S. this year? And do you think that the U.S. can either maintain or get additional stock returns beyond what they've seen last year, or are we kind of running out of room here?
Yeah, I think the thing that you have to consider is probably what we've written on, which is this K-shaped economy, where you have the largest companies, the AI hyperscalers in the U.S. Spending just unfathomable amounts of capital expenditures on AI, on data centers, on procuring NVIDIA chips, whatever it may be. That's really been propping up aggregate figures, whether it be investment figures or whether it even trickle into the actual GDP metrics. And then you have Main Street U.S., the rest of the economy, the lower leg of the K, which we have a shaky labor market and the confidence metrics that we've seen, even just anecdotally from like UMich survey data about job prospects and just broadly employment, the employment environment have been very negative. So you can't really have a situation where the two diverge for a long period of time. So I think something has to give. And I mean, in our recent writings, we've been questioning, for 2026, what is that? I mean, does the K-shape continue to run further for a period of time? Does the top leg of the K, the mega cap companies, the AI hyperscalers, does that start to converge downwards towards the lower leg, or vice versa? And I would say in that regard, I'm cautiously optimistic. The hard data, not the survey data, remains resilient in the US. And as mentioned earlier, we have a number of potent measures from the fiscal stimulus perspective, from the One Big Beautiful Bill, that are going to start to really take hold in 2026. So, our default optimism there is that the lower leg of the K is supported by government spending, and that the current resilient and can build off the current resilience and converge upwards. That would be the positive scenario. Obviously, the negative scenario would be a rollover at the top, and just considering how systemically important and how much weight those companies hold, that's a clear downside risk that we have to remain very vigilant and cognizant of throughout the year. So, if AI monetization doesn't meet the very lofty expectations, for one, there could be a bit of an air pocket there. So that's something that we have an extremely close eye on. But for the time being, as it pertains to AI, I think the data center build out continues, and there's a tangible product there. I think the AI companies have done a really good kind of job hooking the imagination of the consumer by putting out their models publicly and letting the public, whether it be from a household perspective or a business perspective, use these services and integrate some of them into their process and see the value in them. And I think that's really captured the imagination of investors. And I think that continues for the foreseeable future. Like, we don't view it as kind of like a .com sort of thing where there's just, a .com at the end of your name and no real tangible business model behind it. There's a tangible product here, which everyone basically at this point has experimented with and sees a real value proposition behind.
Yeah, I think that's you've outlaid a few different scenarios of that current K-shaped economy. Either it keeps diverging, it converges, or you have a top that rolls over, which could be detrimental, or a lower K that starts to rebound and rally, which would be very supportive of returns. So interesting to see how this all shapes out. But I think there's definitely a lot of things to be watching and taking into consideration for U.S. returns. Mostly are you going to get the same returns, and are there better opportunities elsewhere, which you've broadly kind of addressed so far in this podcast so far. And so with that, I recognize we're kind of getting towards the end of this podcast. There's one thing that, I really wanted to talk about. So I'm going to kind of glaze over the rest of the world section that we talked about. You've already talked about Europe. You've talked about that we do have a favor towards it. You've talked about European financials, both Germany and Sweden as well. And you've talked about it, the Asia, both emerging and developed. And some things we like there. So I want to dive a little deeper into commodities. We've talked a little bit of precious metals. You've certainly highlighted gold. We've made no mention of silver, so kind of gold over silver on that front. We talked about copper as well. And so for those that are familiar with us, we've got several investments within this space, physical gold. We have exposures in Chile, which is the largest exporters of copper globally, and now an extension of that trade, which is global copper miners. Tell us a little bit more of these reasonings and the bullishness that we have on these exposures.
Yeah, copper is perhaps our favorite in the metal complex at present, certainly in the precious metal complex. And there's just a number of factors. I mean, some of them are well known, some of them are more our views. But generally speaking, I mean, first and foremost, we had a pretty sharp copper rally in 2025, and particularly towards the end of the year, a pretty acute rally. And just for the rest of our positioning, that tends to have, which is risk on, that tends to have a good signal. I mean, the old cliche that copper is the only commodity with a PhD in economics. It tends to be very economically sensitive. It tends to be fundamentally driven, not necessarily driven by speculators. And when you have a copper rally, listen up. It's probably telling you something about the trajectory of the global economy and global demand. But I guess the key question then is, well, what is driving this rally? And I really like copper at present just because we view the investment case as quite multifaceted. For most commodities that are priced in US dollars, having a weak US dollar environment is just a net positive from a denominator effect, of course. Also, the interaction of supply demand, so just fundamental economics, it's very expensive these days to build a copper mine, whether that be permitting, environmental issues, or just that the best assets worldwide have already been mined, and new projects may have to target lower grade assets and that sort of thing. So there isn't the ability to have a quick supply response necessarily to heightened demand in the copper market. Now, certainly there are things that can be done. Recycling, as an example, can be scaled up to meet some of that demand. But if demand projections pan out as we expect them to, we expect the copper market to be in kind of a woeful state of undersupply for the foreseeable future, which would definitely support prices. And why copper and why the heightened demand? I think that's also multifaceted. Whether it be infrastructure demand for electrical grid enhancements, whether it be an increasing pivot towards electric vehicles, which use considerably more copper than their ICE peers, whether it be the copper required to run the electrical systems in data centers, which are like a huge new demand source. The list goes on and on. These are things that just weren't really an issue in a previous generation. So there's not a lot of viable kind of alternatives. Copper seems to be the common denominator in a lot of these things. So you mentioned silver. I mean, silver's even had a strong rally, being included in data center demand too, which is kind of an ironic thing. We generally think of silver just more as a precious metal, but it has important industrial use cases in solar, photovoltaics, et cetera, too. So yeah, you got to kind of balance out the lofty demand projections against kind of real world exposure here, but so not get too carried away by some of the expectations looking out over a decade. But either way, I think the path of least resistance should be higher for copper prices. And the question then is just how best to take exposure. And we've posited a few ways, as you mentioned there. So whether it be investing in the miners themselves, who should have considerably higher cash flows if we're correct about the price of their output. And then Chile is another really interesting one too, as their political situation kind of veers back towards a more centrist, more business-friendly approach. And they don't have a ton of copper mining exposure in their equity index, but the earnings of the companies that are doing business in Chile are definitely quite affected by the price of copper, particularly in the financial sector as well, which is highly economically sensitive. So a number of good ways to play it, but we're always challenging the view and looking for other ways as well too.
That was a good response and kind of summary. And I think a woeful mismatch of supply and demand in certain specific precious metals, given some of the increased demand from both AI, EVs, electrification, I think it's warranted. I think you might be or underestimating the positive cash flow impacts of like a 50 to 100% rally in specific precious metals over a 12-month period for some of these miners. So it's been interesting. It's been very interesting to watch. We're running short on time. A quick question about just currencies, and then I'll kind of get to our our final question, which is, book or show recommendation. Last year was a pretty decent weakening of USD and strengthening of CAD. I don't know whether it was CAD strengthening or just USD weakening, but USD's was weaker across the global kind of basket. Just give us some projections for this year. How do we like CAD relative to USD, and then global currencies versus USD?
Yeah, I mean, our base case is that we're in a weak US dollar environment. How acute that will be, I guess, remains to be seen. But we have this view for a few reasons. I mean, first of all, the trajectory of monetary policy, the US is still cutting, whereas a number of other major central banks are not. That includes whether it be Canada, the European Central Bank, or the Bank of Japan actually hiked in December. So from an interest rate differential perspective, that weighs against the dollar. I think the dollar is also increasingly facing a bit of a political risk premium in the near term here, just based on some of the volatility in terms of policy emanating from the White House. And then lastly, and really importantly, global capital tends to flow to the best growth opportunities. And at present, I mean, the U.S. has been, as mentioned, like the star of the show there, particularly their tech sector. But I do think as international markets gain momentum here, they'll continue to suck in capital from around the world, and that should be supportive of their currencies as well. So not necessarily calling for a crash in the U.S. dollar or anything like that. I just think that the pressure is just leaning towards the downside looking into this year.
Yeah, I think the best way to put it is slightly more headwinds than tailwinds this year. I think as a lot of global investors are starting to see their local stock exchanges perform as well, if not better, than U.S., and their currencies start to do a little better as well, and that creates a bit of a repatriation, I would say, effect on investments. So it'll be very interesting to watch that as well. I think we've seen that with Japan, and probably might see that a little bit more down the road. So with that, we're coming to a close. I don't know if you had one, a book recommendation, show recommendation, or even sometimes Tyler likes to throw out there something that you're looking forward to that's not industry related.
Yeah. I think last time I was on the podcast, I had made a recommendation for my DIY electrical book that I was reading, and I've happily finished that one, and I'm on to DIY plumbing at this point. So that's what's filling up the excess brain capacity in David Kletz these days.
DIY plumbing. So we should buy some stock in Home Depot. You're probably making a few trips back and forth there, right?
Well, it's just reinforcing the copper narrative in my mind.
That's awesome. David, as always, this is a pleasure. This is definitely going to be coming out in terms of podcasts. As mentioned, today is Wednesday, January the 14th. I do expect this to be distributed very early next week. And to our listeners, always thanks again for listening. We respond to your inquiries, your questions, your desires. The focus of these podcasts is to share a little bit about what Forstrong is doing from an investment perspective, get some global macro insights. There's so much more that we didn't have time to dive into. What's going on with Donald Trump today? That could be a daily show. What's happening with Venezuela and expected outcomes on that front. But again, if there's anything more that you want to hear from us, please let us know. We're always happy to slot this in there. But David, thanks so much, and we'll see you again soon.
Thanks again, Rob.